Hey, it's time for us to go ahead and get started. I want to thank everyone tonight for tuning in to the webinar. We're going to be talking about the Money Max account. But before we get started, I just want to give you a little bit about myself. I'll make it really quick. My name is Joni Kelley. I'm an executive director with United Financial Freedom. I'm married, been married for 26 years. I'm a mom. I am a grandmother, a wife. We have 7 children, 5 grandchildren. So, needless to say, it stays very busy in our household. But what I'm really here tonight to do is to talk to you about the Money Max account. We started using this account back in 2009, and we've had phenomenal results using this account financially. It has helped us to pay off our former house that we were in. We were in our home for 5 years and heard about this program and paid it off in 7 years after that. And then we have been in our current house for 3 years, and we are due to pay this home off in 4.5 years using this program. Of course, everyone's results are going to be different, but I'm so excited about it that I wanted to become a part of this fantastic company. So, without further ado, let's go ahead and start tonight. So, we're going to talk about who succeeds and who fails. The Social Security Administration did a study. They did a study of 100 people and they worked for 40 years. And after that 40 years, here's what they found: 54 people will be broke. They'll either be dependent on Social Security, relatives, friends, or some form of charity. 36, unfortunately, will no longer be with us. 5 would need to continue to work. 4 will be financially secure, and only 1 out of 100 people will be wealthy. Now, what does that tell us? Well, it's a very sobering reality. For every 100 people, after 40 years of hard work, only 5% will financially succeed. 95% will either end up dead or dead broke. Now, we have to ask the question, why is that? I don't know about you, but when I was young, there wasn't a lot of financial information or education in school. I tell this story all the time. I was 19 years old when I got my first credit card. I knew nothing about money. Went off to college, got my first credit card. They see fresh young meat walking on campus. They tell you to come over and fill out the application. You fill it out. I had an instant $1,500 credit limit, and within 3 years, that credit limit was maxed out. And then what happened is it took me 10 years to pay off $1,500. I'm sure they made 3 times the amount that I borrowed. And that is our financial education that we have in America. And that's also the reason that debt is at an all-time high. I was checking the US debt clock before this webinar. We're up to $28.8 trillion for our national debt. Trillion. And I don't know about you, but I think our great grandchildren are still going to be paying that debt off. And that's just horrible. And it's because of our American way of life. We buy things that we don't need with money we don't have to impress people we don't know. And the result of that, unfortunately, is debt. So if you're tuned in tonight, you're probably here because someone invited you to the call. You want to find out, how do I get out of debt? It's something that all of us want to do. It's something that can heal marriages. If you have people that you really want to help financially, but you're strapped to your debt or to your mortgage payment, student loan payments, credit cards, we want to show you that there is a way to get those things paid off as quickly as possible. And with our current economy, we need to be out of debt as quickly as possible. Debt is, after all, very big business. And the less we know about money, the better the profits are for the financial institutions. It is true that debt helps us pay for things that we want when we don't have the money. But what we have to do is understand the difference between good debt and bad debt, or it's going to cost us our future. Most of us will stay in that minimum payment cycle, continuing to pay fees and interest for years, instead of using that money to invest in our future, in our retirement, leaving an estate to our or an inheritance to our children. So we don't want that. We're going to talk to you about stopping debt in its tracks, because United Financial is truly buying America back, one family at a time. So let's talk about how to pay off debt early. Okay, there's some things that we already know about the traditional banking methods. We have a consolidation for lower monthly payments, refinancing to lower interest rates. The interest rates have been crazy low, and that's an option. A biweekly payment plan is an option. On a 30-year mortgage, though, that only takes about 6 or 7 years off of your 30-year mortgage. Okay, now we also have the financial gurus. There's a lot of famous people out there talking about how to pay off debt. One in particular that we did, I won't say the name, but I remember we were doing things at a gazelle intensity, but it just wasn't fast enough, and we had to reduce our standard of living. We did eat ramen noodles. It was very difficult to enjoy life. Things were really, really tight doing that program. But one of the things that the financial gurus don't seem to agree on, because everyone has different opinions, what do you do? How do you send these extra payments to debt? Do you do the highest interest rate? Do you do the lowest balance? Or do we do like the snowball or debt roll down where we're rolling payments over the next lowest balance or highest interest rate? Well, I'm here to tell you that these methods do work, but they can be very constricting in a normal financial situation. Like I said, we tried several of these methods before we found the Money Max account. I'm talking about my husband and myself. And the Money Max account system helped to keep us focused on target, and we moved very quickly towards paying off our debt. So we're going to talk about that tonight, okay? The Money Max account, with the Money Max account system, there's no refinancing. There's no change to your standard of living. No ramen noodles, okay? No biweekly payments. It's not a debt roll down, not a concept or a theory, but here's what it is. It's a web-based financial GPS system with a roadmap to pay your debts down fast. It's an individualized plan for your situation. Everyone listening on the call tonight has a completely different situation. Some may have student loan debt, car debt. Some may not have a car at all. Some may be married. Someone listening may be single. It's an individualized plan for your specific situation. Okay. It's also for current and future debts. And we have a proven 15-year history with over $2 billion in principal paid down. Now, you might be thinking, okay, what kind of magical program is this? And I'm here to tell you that it's not magic, it's just simply math. And we're going to talk about that math tonight and show you an example, okay? First thing we're going to do is take a look at an amortization schedule. All right, we're going to look at a mortgage of $300,000 at 4%. The payment is $1,432.25 for 30 years. I'm going to take a quick pause because there may be someone listening that doesn't know what an amortization schedule is. I don't want to make that assumption. I'll break it down really quickly. If you closed on a home, you got a stack of papers, and in that stack of papers is an amortization schedule. And let's say it's a 30-year mortgage, like in this example, that's 360 payments, and the bank breaks down for you each month how much is going to interest and how much is going to be going to principal for 360 payments. It's very specific. Okay, so we're going to take a look at an amortization schedule here. Now remember, the stated interest is 4% on this $300,000 mortgage. Now, if you look at column 1, year 1, the interest that's being paid that year is $11,903.83. Now, if you look over at column number 4, the total paid to the bank to pay back your mortgage was $17,187. What does that mean? That means that 69.26% of your money that year went to interest. But wait a minute, I thought it was a 4% interest rate. Well, no, not really. It's 69.26. So let's take a look at year 5. Year 5, you're still paying 63% of your payments towards interest. Year 15, you're paying 55.97%. Look at that. I'm sorry, I said year 15. I meant year 10. But year 15, 46.24% towards interest. You're 15 years in, and nearly half of your money is still going towards interest. Well, if you're listening, I want you to know we've created a better way. We're going to talk about that. But let's take a look again. Let's just recap what we just saw. So for month one, if remember the monthly payment on that mortgage is $1,432. Okay. And of that amount, nearly 70% was interest. 70%. That is absolutely astronomical. Okay, month two. Oh, we're really moving along. You're now only paying $998 in interest. Wow. Let's take a look at year one. Okay, so that year one total in that previous slide was $17,187. Of that, only $5,283 went to actually pay back the loan. All right, let's look at year five. So year five, you've paid $85,935 towards this home, but $28,658 was paid towards the principal. That means a whopping $57,000 went to interest. Let's look at year 11 and 10 months. Okay, year 11 and 10 months, you've paid a total after 11 years of $203,000. But the principal, $70,000. That means off of that $300,000, you've only paid $70,000. Year 19 and 3 months. Look here. You're at the halfway mark of your loan, $149,966. It took 19 years and 3 months to pay half of the amount that you borrowed. So let's look at our totals at the end of year 30. $515,000, and a whopping 72% of that money was interest alone. Now, I want you to understand something. We are not against banks, but what we don't want you to do is throw away unnecessarily money when you don't have to. We're against you paying off your debts in a way in which others get to financially gain from your hard-earned money. What we want to do is show you that there's a faster and a better way to pay off your debt. Keep your hard-earned money in your own pockets and build wealth to pass on to your children and your grandchildren. Okay, so what we want to do is explain to you that the Money Max account gives you a way to jump ahead in your amortization schedule. So let's take a look at the same mortgage, and we're going to play a what if game. What would happen if you could eliminate 6 months worth of payments all at once? Now, by that, I mean, what if you could send $2,615 in a lump sum towards this payment? I'm not talking about your monthly payment. I'm talking about an extra lump sum. Okay, let's take a look at what that would do. That would cancel not 1, not 2, not 3, but actually 6 months of interest. You would save $5,979 off the back end of that loan. Now, just imagine if you could do this over and over and over again throughout the life of your loan, how quickly you would pay that off. Now, we know that everybody doesn't have an extra $26.15 or big lump sums to do that, but we're going to show you a way to do that. Our program combines banking strategies with advanced math and innovative technology in order to ensure every dollar you make either earns interest or it's canceling interest. Now, how is it going to do that? Well, first of all, there's 4 requirements. You have to have debt, a checking and a savings account, and you have to have our MMA program, which is our online financial program. All right. Now, there are some additional options. You can use an advanced line of credit, and by that I mean a home equity line of credit, personal line of credit, or a business line of credit. And what that does, it simply takes the place of a checking account. But I want to stress to you that you do not need an advanced line of credit for this system to work. Most people just simply use the checking and the savings account. All right. Okay, so we're going to show you how this program works, and we're going to show you through 4 money saving strategies. The Money Max account system uses these 4 strategies: interest accumulation, interest float, interest cancellation, and strategic payoff. Now we're going to look at one scenario. Now, this is John and Rebecca Jones. These were actually actual clients of ours. Names have been changed, okay? But we want to show you how this program works using John and Rebecca Jones. I'm going to take a quick pause and say this. Yes, there's two incomes in this scenario, but like I said earlier in the presentation, everybody's situation is going to be completely different, and the system will calculate for that. It'll adjust for that. So you can be single with one income or married with two incomes. You can have different debt structures. I want to point that out as we're going through this example, okay? All right, so the income is $5,000. Their expenses are $4,800, and they have $200 left over after the end of the month. That's called what we call discretionary money. Okay. Their liability structure, they have a mortgage of $200,000 at a 6% interest rate. And again, I know rates are not that high, but this was a past client of ours. All right, and the payment is $11.99 for 30 years. Credit card, right now there's no balance on the card. The rate on the card is 12%, so there's no balance on the card. Obviously, there's no payment. So let's take a look at what happens. Okay, so month one, the Jones family gets paid $5,000, and immediately the program identifies money coming in. And because of the goal of the program is to utilize money coming in to help pay or cancel interest. It instructs John to move that money into the savings account to begin earning interest. Now, at the same time, John and Rebecca will be paying all of their bills, their mortgage payment, car payment, groceries, gas, and utility bills on their credit card. And someone may say, well, wait a minute, I can't pay my mortgage on my credit card. You're absolutely right. You cannot. But in order for us to show you how this program works, we are using this here illustration, okay? Now, at the same time, there it is, okay. At the same time, they're going to make a monthly mortgage payment, which reduces their principal by $199, and they've accrued interest in their savings account by allowing their money to sit in the savings for 30 days. Now, this strategy is what we call interest accumulation. Month two, the following month, their income comes in and it's deposited into their checking account. Now, remember, in the previous month, they've used the credit card to pay their bills, and now the program's going to prompt them to pay it off. Now, when you borrow money at 0% interest and pay off the balance before the end of the month, what happens? You guessed it, there's no interest charged, and that is what we call interest float. So you've essentially floated the interest and used someone else's money without being charged for it. Next, the system recognizes that it's time to pay the credit card. So it's going to instruct them to take $4,800 from their checking account and pay their credit card balance in full. They're going to have $200 left in checking. The system is also going to recognize the high amount of interest that's being paid on the mortgage, and it wants to help reduce that. So it's going to instruct John and Rebecca to move $3,789 over their checking account, leaving a reserve of $1,219 in their savings account. Okay. So also in month two, we're not done yet. The system's still making moves, is what we call it. My husband and I call it making moves. So the system is still making moves, okay? It's going to have them pay $39.89 from their checking account and apply that towards an extra principal payment on their mortgage. Now, this one extra payment is going to eliminate 16 payments on their mortgage, canceling over $18,000 in interest. That is called interest cancellation. You remember that from our previous example. Okay, now John and Rebecca are going to continue paying their bills throughout the month by putting their monthly expenses on their credit card. And then the system will once again instruct them to pay off their credit card at the end of the month. All right, so let's take a look at what happened with that one payment of $39.89 to their principal. Okay, so their loan balance was $199,801, and afterwards it was $195,612, reducing the balance by $39.89. Now look at what happens with their payments. So they go from 358 payments to 342 payments. They've essentially, with that one move, that one lump sum, eliminated 16 payments. The interest, they've gone from owing 231,677 to 212,931. They've wiped out $18,746 in interest. All right, so we're going to look at a side-by-side comparison of this example. We're going to compare a conventional loan program with what John and Rebecca Jones did using the MMA system to pay off their $200,000 mortgage. So the balance after 1 year, $197,543. Using the Money Max account system, we're going to say that you're using the Money Max account. So if you use the Money Max account system in this example, your balance is going to be $184,811. But look at this. John and Rebecca Jones, it will take them 5.5 years to reach the same balance that you have in your Money Max account system. Oh, wow, that's pretty powerful. So 30 years under a conventional program, 10.4 years with the Money Max account system, okay? Total interest, 231,676. And in the example with John and Rebecca Jones, they're only paying $70,422 in interest. Now, I don't know about you, but $167,000 sounds really, really good in the retirement years. It sounds great to be able to leave an investment, or excuse me, an estate to your children. It sounds wonderful to have access to that money to be able to help a family member or a friend or whatever the case may be. There is your savings right there, $167,219. Okay, we're going to talk about strategic payoff. Which bill does the system pay off first, or which bill do you pay off first? Actually, we talked about those financial gurus earlier in the presentation, and let's say this is your situation here. Which one do you pay off first? The more debt we have, the more payoff options there are to choose from. And in fact, according to Fair Isaac reports, they report that the average customer has 13 active creditors on their credit report. Now, I had someone challenge me on that, and I told them that it's not very difficult. I mean, think about it: mortgage, car, student loans, credit cards, store cards. There's a lot of debt out there. So it's very possible. And with 13 active creditors on their credit report, that's over 6 billion combinations. 6 billion combinations. Well, here's what we're going to do. The MMA takes every single aspect of your financial situation into account, but you do have to give it a little bit of information. Okay, you have to tell it how much you owe and for how long. What are your interest rates and interest types? Is it fixed interest, adjustable, simple, things like that? Incomes, you have to give it your incomes. How many are there? Is it one? Is it two? Do you have another side job? Is it three? How much is it? How often does it come in? And is it commission based? And then what's coming down the road? Do you have a vacation coming up 6 months from now? Yes, you can actually put that into the financial GPS, and it will calculate how long it takes you to get the money to go on that vacation. It'll have that money ready for you. Holiday spending. I don't know how many people are surprised that December 25th is every year, but Christmas is coming. So holiday spending, you can now plan for that in advance. Tax returns. And even when unexpected expenses happen, like medical bills, or your refrigerator or your stove breaks down, any kind of home repair comes up, you put that information into the financial GPS, and it will absolutely calculate that for you. Now, every one of us has a GPS on our phone, and I want to talk about that. When you're going somewhere, let's say you're driving out west and you want to see the mountains and it's just so beautiful, you don't know how to get there, you put the GPS address, or you put the address in your GPS. The GPS is going to guide you to make all your turns. It's going to take away the stress of deciding which route you have to take. And when obstacles come up, like that dreaded construction. It's going to help you get around that. All right, GPS helps you to stay focused on the road. It's going to track your success as you follow the route, and your personal GPS on that phone is going to give you the exact time you will arrive at your destination. You are able to plan when you leave based on the arrival time, right? Well, I want to tell you that the financial GPS, the Money Max account, does the same thing. The MMA guides you to pay off all of your debts. It totally takes away the stress when complicated financial decisions come up. It helps you stay focused on your financial plan. It tracks your success as you follow the program. I think that's my favorite part because I can actually see how much interest I've saved, how much interest I've paid, how much principal is left. It gives you all of that information. And it's also going to give you the date. It's going to give you the month, the day, and the year that you will be debt free. And the most important thing, which my husband loves because he's the one that does the finances, you can update this in as little as 20 minutes per month. Now, as I said earlier in the presentation, the Money Max account has a proven track record of over 15 years, paying off over $2 billion in principal. This program is so powerful. It's been featured in several leading financial publications. And in addition to that, it caught the eye of a very important company by the name of Ernst & Young. Ernst & Young is responsible for auditing publicly traded companies to make sure those companies are doing what is right for the consumer. So in other words, they provide consumer oversight protection. Back in 2008, they performed a very intense audit of our financials. They had their accountants go through our program with a fine-tooth comb. And after they did that, they completed their audit. They found that we were doing exactly what we promised to do for our consumers, which is to help people pay off their debt in as little as 1/3 to 1/2 the time. They were so impressed by our company's excellence that they awarded us with the Ernst & Young Entrepreneur of the Year Award, Utah Region Financial Services Division. So we do stand in great company because other companies that have received the same award are like the ones you see here: Apple, Starbucks, eBay, and Microsoft. So we're so committed to helping you pay off your debt. We want to make it easy for you. We want to provide you with your very own financial GPS for your finances. Okay. To date, we have helped our clients pay off over $2 billion in debt. It is a proven fact that in order to achieve your financial goals, you've got to eliminate debt. So as you listened on this call, you may be wondering, will this program truly work for me? Well, the truth is, I don't know. What you need to do is get back to the UFF agent that invited you to this webinar. Allow them to run your free savings report so that you'll know your debt financial freedom date. It does not take long. They need just a very little information, and you will know right then and there exactly how long you will be out of debt. I want to thank you so much for tuning in tonight. Remember, the only thing standing between where you are today and your arrival to debt freedom is you taking action. So don't wait. Take action now. Good night and God bless.